Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host. I want to thank everybody for joining me today. It is Friday, August 7th, and the markets are closed, and we had a pretty exciting week in the market. Let's get it on a weekly chart here. Had it on a daily chart. As you can see, we were down for the week. And as you can also see, it stopped right on our lower trend line of this wedge. And it never ceases to amaze me how incredible that is. How the market can just come down and touch that and then recoil from it like it's magic or something. But anyway, let's zoom in and look at a daily chart, and you can kind of see how the week looked. Last week we pulled up into this area, and I thought maybe we might get a pullback into this area and then go higher, but it pulled back into this area, made a lower high, and then rolled over. And I tell you what, we're really in an area that it could go either way here. And there's, I just have no idea what's going to happen. Obviously, nobody knows, really. You might have somebody tell you that they know, but this looks pretty. This was defended pretty well right here at this trend line. The bears pushed it all the way down to this point here at below 2070. In our support area, so this is kind of a retest of the support area, and then the bulls pushed it all the way back up to here and closed it right there. So, if next week, at the close of next week, if we get a candle that looks like this, then I would, or something even bigger, then we're probably going to have a run to at least this area and very possibly this area, but it could take a couple of weeks. You can see this little move here took 1, 2, 3, 4, 5, 6 days, so a week and a little bit. This move up took 1, 2, 3, 4. So we got about 10 days worth of action here. We could have, another 10 days kind of as it meanders its way up here, if it gets that high. If we make a lower low, if this comes up and all we do is make a lower low, if it comes up, say, like this and rolls over from here, it's probably going to break out of this pattern and go to some of those numbers that we talked about. I would say anything below this area right here on a closing basis, this pattern's probably well on its way to completing. And just to remind everybody, that completion would take us back to the October lows, which are right here, October of last year, by the way. So we're talking about a move. Well, let's just measure that. Let's measure it from here, from this location here. So from right here to that zone would be about almost 14%. So we're talking about a pretty good pullback. I would say, you could wait and see if it pulls that far back, or you could get out in this zone right here. If you're still in, you could get out just below this low here on a closing basis. So once it closes below that, then you could exit. Now, just because I say it's coming to here doesn't mean it could come here and stop it. It's going to at least go here, so it could go lower. The market can do anything. I think that's something that we should not call into question at this point after having all lived through 2008. So let's look at the interest rate market. Let's look at we're going to pull up a weekly chart. So interest rates continue to pull back. We've got this level on the chart right here, this 2.08%, is an area where if it continues to pull back, it's likely to find some support, and then turn and go the other direction. So if you're long interest rates, then you gotta give it to at least here before you get out, or you should not get in until it gets to here. So the interest rate, there's still just tons and tons of risk in the interest rate market. And I think one of the things I think is happening is just there's this collective belief that central banks are, capable of, orchestrating this magic, and as long as people continue to believe that, things are manageable. But if the Fed doesn't raise rates and this market moves out to higher prices, higher interest rates, without the Fed raising rates, I think people are going to really start to question whether the Fed knows what they're doing. And I question that already, but I think in larger numbers, people are going to start questioning that. And the Fed's going to come under a lot of pressure in the coming years. So I think they're playing a very dangerous game. A lot of people too say things like, well, the Fed saved us and the Fed fixed the economy and all this, but you got to remember they still have $4.5 trillion on their balance sheet. So they're only halfway through this little experiment that they've concocted, and to get all the way through the experiment, they got to get that $4.5 trillion off their balance sheet. And trust me when I tell you, that ain't going to be easy to do if it's even possible at all. So, buying bonds when people are happy to sell them to you is no big deal. Trying to sell bonds when there's no buyers, when interest rates are going higher and higher and higher, and there's a confidence problem in the economy and then the dollar and things like that, it's going to be very difficult for the Fed to exit that sizable position. And all the talking about the Fed, save the economy and everything, I think it's very premature. They have not. They're only halfway through this experiment, and I don't think you can really say that until they get all these dollars off their balance sheet and soak up all the money they've dumped into the economy. Who knows? They might never do it. We might have QE4, QE5, on our way to Zimbabwe or whatever. So, let's look at volatility, since we were looking at, volatility spiked a little bit this week, but you can see also it was pretty tame. It didn't really get out of hand. It finished the week at 1339. That's pretty low, but you can see there's kind of a long tail here and a long tail here. So we had a big range in volatility, but the open and the close, pretty much it closed right where it opened. So net, there wasn't a lot of action in the volatility this week. Japan continues to print money, and it looks like it's actually going to make it up into this resistance zone that we have. And then, of course, what the market does after it gets into resistance is it turns, it pivots, and goes back the other direction. And the other direction would be around, the top of this box. Have it pull back to the top of this box area. And then presumably continue higher. The UK still looks weak. I mean, it's kind of traveling sideways, but it did break out of this rising wedge pattern. Traded down and then came back up into resistance, and it's kind of been trending sideways to down. So until the UK breaks out of this zone in here, and we'll look at the FTSE here in a second, which is should be a better chart. Rather than looking at these ETFs, these ETFs aren't as good as the actual indexes. We can look at the Wilshire. The Wilshire, the reason to look at the Wilshire is it's just got so many stocks in it. It's 5,000 issues in the Wilshire. So, you can see that, man, it is very tight in here. The price action of the Wilshires is coiling up. It's getting tighter and tighter and tighter. In fact, to see really kind of what's going on there, you've got to maybe look at a 6-month chart. And you can see the same kind of wedge, although it's really kind of broken out of the wedge, at least the way I have it drawn. It could be that I need to draw that differently. Yeah, see this line really should be down here somewhere, say right there. And then this line, you can see if I connect these lows here, the Wilshire looks a little weaker than the SPY or the S&P 500. You got a touch here and a touch here, and then pretty good breach here. So, but if you look carefully, and these are some of the subtle things you got to learn to notice. There's a low. Well, you can see here. These are all higher lows. Here's a low. Here's a higher low. A higher low. A higher low. A higher low. Now this low wasn't higher, but this is all part of the same downtrend here. So we're looking at this one. This is a higher low than this. So the trend technically is still intact. The Wilshire could, from here, have a series of candles that look like this. Maybe even a big one here that takes us, to new highs. So it's still too early to say that the market's done here. We could very easily have a situation like this, make a new high, and then potentially break out substantially from here. But I'm going to tell you in a minute why I think that's probably not going to happen. And we'll look at the S&P 100 and just rifle through a few stocks. Really, I mean, you had some leaders in the market. Let me look at. Let me go back to a 1 year. Apple was leading the market. Here's Apple, and you can see this is a pretty sharp decline for Apple, and it's based on earnings. So the way I would interpret that is, some new information came to the market. The market gapped down, so big money people that own this stock gapped it down. And really what you like to see when you get a gap down or up is you want to see the stock just kind of go sideways from there, and then you want to see it kind of go higher. When it gaps down and continues down like this, is usually not very positive for the stock. These are just observations I've made, over the years or whatever. Ambarella was a leading stock, still is a leading stock, but you can see here, it gap down, went down, but then just kind of traded sideways for a while, and now it's kind of going back up. But, I mean, this isn't a very strong move, and Ambarella, it could trade sideways for a while, or who knows, maybe it's not done going up. But it did have a pretty severe correction here. I would say it's got a move into an area around, say, this area right in here, around 135, 137. And then I would look for Amarillo to at least pull back into this 90 area before either going higher or breaking down further. Let's see what other stocks were leading. Amazon was leading. You can see Amazon, it sold off intraday, so it gapped up, ran all the way up, sold off intraday, kind of traded sideways, is now starting to move lower. IBM has really been a dead stock for a while, but you can see the same thing. It gapped up on earnings, and then boom, they immediately sold it off and just dropped it like a rock. Netflix is one of the only companies that's really still holding on to a good solid uptrend. There's a few others. There's BIIB. See Biogen broke down. Amgen, I think, is still okay. It's kind of trading sideways. The biotechs finally started to crack a little bit. They were one of the few that were holding up. Goldman Sachs, some of the financials, Bank of America, still holding up okay. Citibank, still holding up okay. But more and more of these sectors are rolling over. And when there's, the indexes are just made up of percentages of the overall stock. So as the stocks begin to roll over and go into downtrends, that puts more and more weight on the indices, causing the indices to finally roll over. So this is the S&P 100. We can just look at a couple. So 3M in a downtrend. Abbott Labs still looks pretty good. Accenture still looks pretty good. Allergan. A lot of the this is Allstate. A lot of the insurance stocks are looking worse, and I think that probably has a little bit to do with the expectation on interest rates. Altria, this is the people that make cigarettes. We already talked about Amazon. American Express, downtrend. AIG's still an uptrend. Amgen still an uptrend. We talked about that. Anadarko, everything oil's downtrend. Apple, it's the thing about it is you can see this blue line I've got drawn here. This blue line goes back. Let's see how far it goes back. It goes back to mid-2013. So, if it breaks this line, which it really already has, I mean, you can see Apple move all the way back to 50 and still be in a very, very long-term uptrend. So I would not be a buyer of Apple right here. I would wait to see it kind of firm up a little bit if I were interested in buying Apple. AT&T still is okay, kind of choppy. Let's see what other ones we have. Berkshire Hathaway is in a downtrend, although albeit shallow. Biogen, that was a leader back in here, and it got whacked, and it's going lower. I mean, look at this thing. Got all the way to $500, and now it's at $300. So it's lost $200 just since March. Boeing, kind of in a downtrend. Bristol Myers still okay. Capital One, kind of okay, but it's broken at this point. I mean, Capital One had really bad earnings, and it dropped way down, lost a ton of its value. Caterpillar's been down in a downtrend for a while. Celgene still looks okay. Chevron down. In fact, Chevron and Exxon are two of the biggest oil companies, but Chevron looks much worse than ExxonMobil. Cisco, Citigroup still looks okay. Like we said, Coca-Cola's been kind of sideways or down. Colgate Palmolive, kind of sideways. Comcast, all the media stocks got hit. Disney, Viacom, Comcast. Can't think of any others, but they all got hit basically after after Disney reported, talking about problems in the cable network business. And this all goes back to ESPN and Verizon driving a wedge into that whole bundle program, and that's probably going to get pretty disrupted here. And I wouldn't be surprised if you start seeing the cable companies break up these bundles and start doing more of an a la carte kind of offer for entertainment. ConocoPhillips, you can see, is way down. Costco pulled back to the 200-day moving average and bounced off. That's usually a good sign. So I would say Costco's not broken here. It still looks good. Devon is oil, looks bad. Disney, you can see their earnings miss here. And this is what I'm talking about. See this gap, and then it kind of pulled down even further. That's usually not very good. To me, what it says is Disney's going to rally a little bit here, and then probably roll over and go lower even still. Dow Chemical looks pretty broken here. It's trading below the 200-day moving average. DuPont below the 200-day moving average. EMC below the 200-day moving average. I mean, when stocks start getting below the 200-day moving average, then what happens is the 200-day moving average starts to act as resistance. So let's go look at EMC, for example, here. This is a great example. So a lot of times what you'll see here, see the stock here's the 200-day moving average right here. It's this line right through here. And so you can see what happened. It sold off hard. See how it rallied up to the 200-day moving average right here, and then sold off. And then it rallied up to the 200-day moving average. Actually went through it a little bit, which happens. I mean, it's a zone. Think of it as a zone, not a specific point. But if you get a break, you can see the close was not below. This is the high week here. If you get a close down here, this is going lower. So that 200-day moving average is that's a great entry point, great risk reward to risk area. Your risk being this zone right here, from here to here, and your reward being from here down to this area here below, just below this pivot. So it's not even on the chart. So $20 or so. Okay. Let's see. eBay still looks okay. Emerson looks horrible. Again, here you can see the 200-day moving average. Now, this one, it breached it quite a bit and then rolled over. So, and then here you can see the 200-day moving average was a bigger level of support. So sometimes you have to, if you were shorting this, sometimes you have to enter a couple of times to get it right. It just depends on how much you're going to let it wiggle. You can see here the 200-day moving average is providing resistance here. And stock broke down. Exelon broke down here. Facebook still looks pretty good, so that's one of the leaders that still looks pretty good. Twitter, though, on the other hand, Twitter is horrible. I mean, Twitter just, it wasn't a year ago. It was $55. Now it's half that. So you can't fall in love with these stocks. You gotta treat them like a business. Ford Motor Company sideways to down. General Electric sideways to down. General Mills down. Halliburton, another oil down. Hewlett Packard down. Intel downtrend. IBM we already talked about. Kinder Morgan's the oil and gas complex. It's down. So there's just a ton of stocks that are down. Norfolk Southern transports. This is a transport. It's down. Speaking of transports, you got UPS. You can see it's down. It's maybe got a little snapback rally here. So it drifted down, and then maybe you got a little snapback rally here. But I'm expecting UPS to roll over again. FedEx. more of a sideways pattern, but now trading below the 200-day moving average. So, it just looks like there's a lot of risk there. I mean, I would not be a buyer of any of these stocks right now. Qualcomm down, Schlumberger down, Southern Company down. A lot of these utilities are very capital-intensive businesses, and so a lot of times if interest rates are expected to rise, you'll see utilities fall. So that's what you got going on here with Southern Company. Starbucks still looks really good. People keep drinking the coffee, I mean, $5, $6, $7, $8 coffee hadn't scared anybody away yet. Target looks okay. Texas Instruments, a lot of the semiconductors are down or sideways. Here's another media, Time Warner. You can see on its earnings, it got whacked pretty good. 20th Century Fox also got whacked pretty good on earnings. All this, there's a huge mix-up in the media area. Probably going to be some consolidation, meaning somebody's probably going to buy somebody else. The thing about it is a lot of these companies have debt. They have a significant amount of debt. So, if they, to the extent they can't service that debt, they may have to consolidate and join forces with another company in order to, survive. Union Pacific, it's in the transportation area. It's down. We looked at UPS. United Technologies is down. Here's a couple that are interesting. Verizon, a little bit down. But this one's another one. Walmart. Look at Walmart. Walmart is in a downtrend. I mean, if ever there's a bellwether of how the economy is going for the masses, Walmart should be that bellwether. You can see it's trading way below the 200-day moving average. In fact, right here, Walmart, you can almost look at this as a great place to potentially go long. You've got a low here, a higher low, and so far a higher low. Now, what you want to see happen is you want to see, Walmart. Whoops. Let me erase that. You want to see Walmart, make another candle, preferably one like this, or better yet, even better than that, one that's inside the range of this previous one here, like this, and then maybe a tail, like a tail that goes down to there, but a higher low than this low here. So let's call that a higher low, and then a candle that looks something like a close above that. Gosh, I keep doing the wrong one. A close above that, like that. It's a great entry right here. You would enter right there. So enter here, put your stop in below here. So this is your risk from here to here. So maybe put your stop in here. This is your risk. And then I would look for, Walmart to move up into this declining 200-day moving average around $77, $78. So you got a pretty good move there, pretty good trade in Walmart. And these happen pretty quick. I mean, it's going to run up something like, like this. And they happen really fast. These are pretty violent moves. Counter trend. And you don't want to give it any wiggle room. As soon as you see a close below the high, so it makes a high, and then you make a close below the low of that high, you want to get out. Because these counter trends, you could have a situation like this one right here where just bam, Anytime you're trading against the trend, you run the risk of having like a surprise move going against you. So just be careful with that if you do try to trade Walmart. Let's pull up NinjaTrader and look at crude oil. Let's go to this one, the weekly. So this is a weekly chart for crude oil. Doesn't look like this is going to happen. Looks like we're just going to go make a new low at this point. Probably take this stuff off. One of the things I was looking at on crude oil is a monthly. I thought I already had it up there. I don't see it. So I was looking at a monthly chart on crude oil, and it's a little bit more revealing and easier to read. Just wait for it to pull up here. Should be pulling up any second. My internet is slow, but I don't think it's that slow. There we go. So let me take some of this stuff off. You can kind of see, here's your kind of your wave 4 and then down. And so what we're looking for crude oil to do is to come down into this, maybe the mid 30s area. And it could rally from there, but ultimately crude oil is going to make a low probably below the 2008 low is my guess, which I think was $32. So if you're in the energy business, start making yourself look really useful. Try to hang on to your job, because there's these managers they're going to be looking to probably cut costs. They got some of this capital is already spoken for. These projects they're already invested in. They can't pull back from them. They're just too far into them. And so in order to cut costs, they're going to look for people who aren't on those projects and things like that, and probably going to try to lay them off. So just be careful if you're in the energy space. Looking at gold, gold is actually really interesting right here. You can see we've had a 5-wave move down in gold. And when you've had a 5-wave move in any market, you should look for a counter trend move. And usually this first move of the counter trend is pretty rapid. So we could see gold. Again, we want to see a close. So let's just talk about entry here for a second. This is let me see. Was this a monthly chart or a weekly chart? I can't remember. Oh, it's a monthly chart. So what we would do, let's go to the weekly, because monthly's too far out to, it's just too much to. Nobody wants to sit around and wait for a trade for that long. So here's the weekly chart here. And what you could do is just keep an eye on what the low week is. So right now, the week of the 24th is the low week. So if we're looking for an entry, what we would do is we would enter at a close above this high. So that's what we're looking for. So we're looking for a candle next week that looks something like that. And then we would enter. And then so let's just call that, let's call that $1,100. So $1,100, let's go, and then trade it up here to this, this 1430 area. So you're talking about maybe a $330 move in gold. It's a pretty good trade. Now, one of the things I'm seeing here, which tells me there might be a little bit more downside, as you can see, it's starting to get into the strength band. So this band, what it does is it travels like this upward, and if you start getting bars into the strength band like this, it usually means you're going to have some up and then back down a little lower. But you have to get a little up first, so it could kind of be a head fake, get you into the market. So just be careful with that, because the market could go up here a little bit and look like it. Okay, it's time to get in, and then actually go make another low. That's what sometimes you see when you see these bars get into the strength band on either the upside or the downside. While I'm looking at charts here, if I see a good example of that on another chart, I'll show it to you. Let's see. I wanted to see here's the DAX. So the DAX is kind of right in the middle of these key areas. And a lot of times when you're right in the middle, it's never a good time unless you feel strongly that the market is down from here. You could enter right there, but you can see the DAX here. We've had, not sure if that's a good piece of data or not, but even if it's not, you still got a 1, 2, 3, 4, 5. So you got a 5-wave move. So I would look for the DAX to pull down relatively quickly into this area here. When I say relatively quickly, I mean like over, this is a monthly chart, so I would say over maybe the next month and a half, you might see the DAX rip down into this area here. In fact, it might just go a little bit higher and then rip down into this area right there. So I would say you're probably pretty close to a pretty violent move downward in the DAX. So if you're trading in Germany, you might want to keep that in mind. I was looking for, let me just pull it up on this chart. I've also got the FTSE 100. For the longest time, we had somebody from the UK watching these videos, so I want to mention the FTSE. It's an important market for sure. Lot of volume, a lot of trading going on in the FTSE. So the DAX and the FTSE are probably the two most important European markets. Probably the most heavily traded markets too, I'm guessing. So let's look at, thought I pulled up a monthly. This is the FTSE. You can see it looks a lot like the S&P 500, which is, a challenge, right? The S&P 500 has been a challenge. So FTSE looks like it might, looks like it might go a little higher here. I would look for a move up above this pivot into the 71.33 area. But that also looks very suspect. It could be that this high's already in and this just drew the pivot in the wrong place. So I don't know if I'd place a whole lot of weight on that. Bonds, we talked a little bit about that already when we talked about interest rates. But bonds look like they want to go a little higher here, and you've got kind of a correction. So we could see a new high in bonds. It's hard to believe, but especially our bonds aren't in very good shape, but maybe compared to France or Italy or Spain, maybe we're looking a lot better. So if those countries start to have problems, you could have money flowing into the United States, and it's probably a function of that. Of course, that'll be very short-lived, and then we're going to have our own problems, but that could be a year or two down the road. And when I say our own problems, we could have problems in the stock market sooner than that, but we could have problems with our sovereign debt, our $18 trillion debt. That might be a couple years down the road or so. That's really all I have this week, everybody. One of the neatest charts I thought is just this gold chart, this monthly. It's almost a perfect 5-wave move. And so when you have something like that, you definitely want to pay attention to it. All right, everybody, that's it for this week. Thank you for tuning in, and hope to visit with you next week. Maybe we'll have a little bit more clarity next week and can make some more definitive pronouncements. But I would say in the S&P 500, do you see anything, a close below 2040, you might want to get the heck out of the way. And we'll leave you with that. Take care, everybody. Bye.